Good afternoon, my name is Julian Navarrete. This is the eighth week of covering the financial markets, and instead of covering all sectors, this week I'm going to present to you the earnings report for six major financial institutions, four of which are the four major banks: JP Morgan Chase, Citi, Bank of America, and Wells Fargo. The two others are BlackRock and Morgan Stanley, which I found had interesting earnings reports. To get started, we're going to look at JP Morgan. JP Morgan Chase actually sets the tone for most financial institutions. Analysts, investors take into consideration how well JP Morgan Chase did in the previous quarter and relate them to similar banks or similar financial institutions. And they can adjust for their stock prices of how well and how poorly they did. JP Morgan Chase actually beat on profit. Their earnings per share came in at $1.55 per share versus an expectation of $1.43 per share. They also beat on revenue at $25.2 billion versus an expectation of $24.16 billion. One major point that I wanted to look at during this earnings season was their trading revenues. Trading revenues across the board were all positive. And I'll get into it into detail, but I want to give you the background of how important trading revenues were. Trading was down in volume for most of 2016. We're around the halfway point, but mostly the Brexit concerns and the Brexit aftermath really gave a boost to trading revenues for most banks. Later on, I'll tell you how CEOs reacted to all this, and in their note they mentioned the Brexit being a very important factor for their trading revenues. So to continue on, JP Morgan Chase had trading revenues at $5.6 billion versus an expectation of last year of $5.16 billion. So this comparison amounts to a 23% year-over-year increase. And that's a fairly important number. We're going to see later on how well the three other major banks did too. And to continue on, Wells Fargo has been a very important factor in this week. Total revenue was an increase of 4% to $22.2 billion. Deposits up 4% at $1.2 trillion. Total loans up 9% to $950.8 billion. Very important to understand those loans, because that's essentially how a bank earns their cash, right? A major part of their revenue. A lot of loans, how well they're going to get from those returns. And to see an increase of 9% is very positive for Wells Fargo. Their net income down 2.8% at $5.6 billion. In particular, mortgage banking revenue was down. Also, equity investment earnings were down. Overall, in their community banking is essentially their checking accounts, their saving accounts, their student loans, their auto loans were down 1%. That's the stuff you and me kind of are considered common. They're common to us. They're community banking. We're not really, not yet, but that's what we see on the day-to-day basis. Our checking accounts, our savings accounts, if we want a loan for a house, whatever it may be, well, that's down 1%. Meaning we didn't go into their bank and try to figure out what we can take from their bank or borrow from their bank. Down 1%. Not an incredible amount, but still something to consider. Also, Wells Fargo, interesting news article that I read, and I think a lot of people read, was the Amazon Prime partnership. So students of Amazon Prime are now essentially partnered with Wells Fargo. They slowly crept into the student loan sector, student loan department. Students can now link up and get student loans at around a 0.5% interest rate. That's an incredible amount. Compared to what I took out, I would rather go with Wells Fargo, and this is very important for the coming year for new college students. Very important. Amazon, huge target audience. They've targeted so many people, busting out. Taking out a bunch of people from brick and mortar stores. They're really strong in e-commerce. They have a great marketing platform that Wells Fargo has recently tapped into, and I think that's an important factor for Wells Fargo, and I think in the future Wells Fargo is really going to reap the benefits from this, definitely. To continue on, Citigroup reported revenue of $17.55 $17.55 billion versus an expectation of $17.56 billion. Their profit, or EPS, is $1.24 a share versus $1.10 a share that was expected. Overall, the revenue down year over year, whereas $19.5 billion, and their profit last year at the EPS was $1.45. Last year was completely different. Something to mention in this, and something that I forgot to mention at JP Morgan Chase, sour energy loans. Energy loans were an incredible factor in a lot of these reports. Jamie Dimon recently came out with a comment that, aside from these sour energy loans, our departments have been reaping a lot of profit. Sour energy loans. With the volatility of the oil and gas industry, we saw that for their loans. A lot of sour loans going out for the energy sector. So Citigroup also reaping the consequences of those sour loans as well. But trading revenues, I wanted to link up on trading revenues for Citigroup. Citigroup had trading revenues of $4.66 billion versus a $3.85 billion year over year change. So that's a little less than a $1 billion increase, which is positive for their trading revenues. I think, and I believe, it's coming from Brexit. Brexit was a huge factor. A lot of people lost a lot of money, whereas a lot of people, the cool, calm, and collected people, kept their money and really took in some more profit. Brexit came out with a lot of opportunity. There was a lot of opportunity to either lose money or take money. And I think Citigroup did well in that. Their net interest margin stood fairly, it's at 2.86%. Net interest margin is essentially how well an investment has been returning for the banks. It's similar to a gross margin, so how much it costs to produce a product, and and if it's a negative number, it costs more to make it than to actually sell it. So they've been doing something positive for the net interest margin at 2.86% versus last year at 2.95%. Definitely something positive. Also to note, Citigroup, their fixed income revenue at $3.47 billion versus the $3.14 billion last year. Very important to see in their fixed income. We'll see later on how important fixed income has become one of the biggest markets in finance. But it's been pretty tough with such low interest rates. Such low interest rates, not a lot of people or not a lot of banks can earn on those loans. Sure, I would love a mortgage loan, or I would love to take out a loan at such low interest rates, but banks can't have enough profits to make it profitable. They're not getting their returns at like a nice 2% or a nice 3%, nice 4%, whatever it may be across the board. It's still low interest rates. To continue on, Bank of America beat on both revenue and earnings per share. Their revenue came in at $20.6 billion versus an expectation of $20.4 billion. Earnings per share was 36 cents versus a 33-cent expectation. Positive. Their trading revenues, $3.70 billion versus a $3.44 billion expectation. Trading revenues, all positive across the board. It's incredible. Also, to continue on, fixed income currencies and commodities, their revenues were $2.62 billion versus $2.34 billion, up 22% year over year. 22%. Wild. So I'm going to move on to Morgan Stanley and BlackRock. Morgan Stanley, I believe in that company. I believe in that financial institution. BlackRock as well, huge asset management firm, and it's just really nice to see their numbers. Really nice to see how they're doing. Morgan Stanley's profit was down 12% to $1.58 billion. Revenue for Morgan Stanley was down 8.6% to $8.9 billion. Their trading revenue down 2%. Though they made $1.3 billion in trading bonds, currencies, and commodities in quarter two. So something positive still up there. Later on, I'll show you the difference between last week's numbers versus this week's stock price. That's a little later in a few moments, actually. But yes, if I haven't mentioned before, recent months cut 25% of fixed income staff. 25% of fixed income staff have been cut from Morgan Stanley. Not a lot of people are investing in that right now. So they had to cut to make their profit increase, let their expenses go. Cut off the fat, essentially. BlackRock, revenue down $2.804 billion from $2.905 billion last year. The earnings per share was $4.75 a share, down from $4.96 per share last year. So not too great for BlackRock, but we see they made a solid increase across the week. Though to finish up, assets under management rose 4% year over year to $4.9 trillion. $4.9 trillion for BlackRock. Very important. And I wanted to consider what these CEOs thought about their earnings report. So these CEOs, Jamie Dimon, John Stumpf from Wells Fargo, Citi, Michael Corbat, Bank of America's Brian Moynihan, BlackRock, Lawrence Fink, and Morgan Stanley, James Gorman, they all mentioned Brexit and how important Brexit was. Brexit was created not just the volatile events of this quarter, but Brexit was a huge deal in the latter part of quarter two. Quarter two was very slow until Brexit. Brexit considered a lot of investors' attention. So all CEOs took note of their volatile quarter, how resilient their banking institutions were, their financial institutions were, and of course how Brexit offered a rocky ending to the quarter. But yes, to continue on with this, I wanted to figure out what was the difference between last Friday and this Friday. Last Friday's numbers were strong due to J.P. Morgan's earnings report. J.P. Morgan came out with some solid numbers. They really set the tone. And now I wanted to consider this Friday. So the week is over. Most of these banks have reported solid numbers, either low or high, but they've all reported. And I thought it was important to see what the percentage change is in each stock price. And I've taken the stock prices from all legitimate websites, such as Bloomberg, Wall Street Journal, whatever it is, Yahoo Finance, Google. But all of these numbers I found, their closing number on July 15th versus today, this Friday at 4 p.m. So JP Morgan and Citigroup all had a negative percentage change, and it wasn't that different, but you still see they're in the red. Bank of America, Wells Fargo, BlackRock, and Morgan Stanley all in the positive numbers throughout the whole week. And you see, especially BlackRock and Morgan Stanley, they all slowly increase throughout today. So if you get a chance, you should look at Friday's one-day average. One-day average was fairly interesting to watch. I was going to cut it off at 3 p.m., but their numbers just kept changing. The volume, and I didn't know this for a while, but a lot of the trading volumes occur during the beginning of the day. So when the markets open up, there's a lot of trades going on, and as soon as 4 p.m. comes around, there's a lot of trading volume around that. You see this like little concave curve of how their trading volumes occur. But yeah, I thought it was really important. I thought it was interesting to me what the percentage change is. So if J.P. Morgan sets the tone, I want to know how BlackRock's doing, or I want to know how Morgan Stanley or whoever it is. But I want to see the percentage change, and I thought that was very important. Definitely. Their net interest margin, their efficiency ratio, I didn't really get to talk about that, but efficiency ratio was very important to take into consideration. Their measurement, a great measurement to see how well their investments are doing and how well their internal controls are doing. Essentially, how well like a bank is doing inside. And I thought to look at an efficiency ratio gives me a broader understanding of how well a bank is doing. I want to close it out. I appreciate the time. 14 minutes. I hope you learned a lot because I know I did. I appreciate you taking this time with me. If you have any questions, if you want to check my numbers, let me know. I have it online. But thank you, and I appreciate your time. Have a great weekend, and cheers.